I'm Mr. Simons and welcome back to our discussion about monetary policy. Again, we're looking at the implementation of monetary policy, and what we're going to do today is we're going to tackle part 2. What does part 2 involve? Good question. If you remember our plan, who remembers our plan? First step, and the previous video, you can click on the top right link to go back and watch that one, was about the cash rate. Step 2, we're going to be talking about what's known as domestic market operations, or DMO. DMO is the way the RBA increases or decreases funds in the short-term money market to target the value of the cash rate. So DMO is the way that the RBA does this. DMO is the way that the RBA can either increase or decrease money supply in the way that we've looked at in previous video. But how does the RBA go about implementing domestic market operations? Now, this is a tricky question that we're going to take bit by bit. So the first thing to think about is a little bit out of left field, but please bear with me. It will all come together in the end. Firstly, Australia's commercial banks, so banks like the Commonwealth Bank of Australia or Westpac, they have to hold a certain percentage of funds with the RBA. They have to hold an amount of money with the RBA. And that what happens is that the banks use these funds to settle payments with other banks and the RBA. These funds are held in accounts, and these accounts are known as exchange settlement accounts, or ES accounts. So to try and understand this concept, let's look at an example. So let's take an example where a customer, or shopper, say this is the shopper, and this shopper has their accounts with ANZ Bank, right? The shopper is real happy because they're about to go to the store. Now let's imagine that the store they're going to is a bank with Westpac. So what happens is that this shopper gives their hard-earned money to Westpac for whatever goods this shop offers. As a result, funds will have to go from ANZ Bank to Westpac because this guy is a customer with ANZ and this shop is a customer with Westpac. So ANZ, the bank, owes money to Westpac for this transaction. And this transfer of money occurs between the bank's ES accounts. Now remember, the ES accounts, those are the accounts that the banks hold with the RBA to settle debts with each other. I just said that. These ES accounts are held with the RBA. So these ES accounts allow banks to settle accounts between them, between each other, and the RBA. For example, some banks will have to borrow to settle their daily transactions. So if their outflows to other banks exceed inflows, they're going to need to get some extra money in their ES accounts. But other banks will have surplus funds, right? They'll have too much money because more money is coming into their ES accounts than they have to pay to other banks to settle debts. Here's the kicker. Here's where you should pay the most attention. Obviously, you're paying a lot of attention this whole time. If banks need to borrow money to top up their ES account balances, they borrow funds in the short-term money market. And wait, what is the cost of borrowing in the short-term money market? It's the cash rate. Okay, if banks need extra money to increase the balance in their ES accounts, they borrow at the level of the cash rate. But if banks have more money in their ES accounts, they can lend funds to other banks in the short-term money market. Oh wait, the reward they get is the value of the cash rate. So, if there is a greater supply of funds in the short-term money market, that will reduce the value of the cash rate and make it cheaper for banks to borrow funds to settle their debts with each other. Okay, if there's a greater supply of funds in the short-term money market, if there is an increase in money supply, that will make it cheaper for banks to find that extra money. But if there is a reduced supply of funds, in the short-term money market, that will increase the value of the cash rate and make it more expensive for banks to borrow funds and settle debts with each other. So what you should do is think about these 2 points in particular. Remember, the RBA controls the supply of funds in the short-term money market, and this is how it changes the value of the cash rate. So when we talk about, okay, increase in money supply or decrease in money supply, who is doing this? So what we can see is that there is a connection between the cash rate and the actions of banks. And that's what we're going to tackle in the next video. Okay, we're only part of the way through our plan. Come back for steps 3, 4, and 5. Subscribe so you don't miss the next videos. Also, why don't you go watch the first video? It's very good. Thanks for watching.